Welcome everyone to Origin Investments Public Securities webinar. Hopefully many of you were on the webinar yesterday. We thought it went well and we appreciated everyone's questions. We'll be following up on the private side as well. I'm David Scherer. I'm one of the two principals and co-founders of Origin Investments. My partner Michael Eppenskope and I founded Origin Investments in 2007. 2 years ago, we added the public security side to the firm. And a year and a half ago, we hired Geoff Scherer to lead that operation. Geoff has experience both at Duff & Phelps and JP Morgan over the past 13 years, and he both creates and rebalances and selects the businesses or the publicly traded companies that comprise our public REIT portfolios. So I'm excited about talking to Geoff today. I obviously talked to him quite a bit, but we're going to share those conversations with you today. A little bit of housekeeping about how this will work. Thank you for those who sent questions prior. We're going to try to address those both through the conversation, but also at the end of the call, we'll have something called Origin Take 5, where Geoff is answering those questions in rapid fire that I'll ask of him, probably in somewhere around 5 to 15 seconds. If you want to ask questions in real time, just as yesterday, there's a Q&A function on Zoom, and you can go down to that and ask it in real time, and we'll also try to address as many of those questions as we can. Please don't ask questions about international REITs because we don't cover them. We only cover US REITs. But other than that, we're going to try to be very broad and accepting of all the questions we get. There is no question that is a bad question. Probably a lot of other folks are having similar thoughts. So without further ado, I want to get started. We have a lot to cover. Geoff, first question, why don't we just define what a REIT is? What is a publicly traded REIT?
Sure, Dave. Really what a REIT is, it's a company that owns real estate and generates their income from the rent from that real estate, or a company that lends on real estate and collects an interest on the debt. But really what a REIT is, it's a tax election. And what a REIT does, if they follow certain rules, probably the most important is that they need to pay out 90% of their taxable income as distributions to shareholders. There's a bunch of other rules they need to follow. They've got to have a board of directors. They've got to have at least 100 shareholders. A bunch of rules that we could talk about in depth. But if they adhere to all these rules, they can avoid taxation at the corporate level and rather pass through the earnings directly to shareholders. So really what it is at the end of the day, it's a tax election status.
So my guess is if they're not paying corporate taxes and they have hard assets that are collecting rents, is it safe to say that their dividends are typically higher than other publicly traded companies?
Sure. If you compare the REITs to the S&P 500, over long periods of time, the REIT level of dividends is, it's a multiple of the S&P 500. It might be 2x the average distribution. It just depends on what time you look at. But yes, REITs are generally heavy dividend payers.
And so let's talk about the historical performance of REITs. I believe they make up 3 to 4% of the S&P 500 anyway. Is that accurate?
Yes, I think it's just under 3%, but plus or minus 3% in the S&P 500. They are their own sector now. They're one of 11 sectors in the S&P 500.
Yeah, so investors and folks on this webinar, they should understand that just by being in the S&P 500, you have some exposure to REITs, roughly 3%. However, it's our belief you should have more, and that will kind of transition into the historical performance of REITs versus the S&P 500. So, Geoff, why don't you speak to that?
Yeah, if you look over, long periods of time, 20 years, 30 years, 40 years, REITs have outperformed the S&P 500 on a total return basis. That means that you're taking your dividends and reinvesting them. But on a 20-year basis, the contrast is quite stark. REITs have returned almost 10% per year compared to the S&P right around 5%. Now the 20-year period, it's a little interesting. You're basically starting at the bursting of the dot-com bubble. where REITs held up very well in that time period when most other stocks were going down. But they didn't really participate in the run-up in the dot-com bubble. But like I said, even over 30 or 40 years, REITs have still generated better returns than the S&P 500.
And candidly, that's why myself as an investor, I'm so invested in this space, because you have hard assets that collect rents that are contractual, that also have a favorable tax treatment and have also outperformed the S&P. And that doesn't make sense to me. It seems like it's almost too good to be true. But to Geoff's point, if you look back 20 or 30 years, it still holds up. So it's interesting. But as we know, Geoff, not all of these REITs, and even REIT sectors. So when I talk about sectors, I'm comparing an apartment REIT and all of those publicly traded apartment REITs to a retail REIT, to a data center REIT, to a cell tower REIT. Believe it or not, there's REITs that are nothing more than they collect cash flow streams from cell phones and all the bandwidth you need. Obviously, that's a growing sector. So why don't we speak a little bit about how you need to be right about these secular trends, and specifically what's happened in this correction, or even before this correction, right? What happened for the last 3 years, if you were to compare, for example, all of the retail publicly traded REITs to all of the publicly traded data centers and tower REITs?
Yeah, that's a lot to put together, but I think there's some trends that you could peel away from that, even prior to the current pandemic. Hotels have been suffering for a while. Most of that has been on the back of new supply, especially in some markets like New York City. So it's not like they were doing fantastically before this pandemic. They had been struggling. Granted, they were in a much better shape. The retail's kind of been in a funk for a while, especially the malls. Obviously, people are taking note of e-commerce and going to the malls less and less. The malls are trying to, reconfigure themselves to be more experiential versus, just selling apparel. But malls have kind of been in a funk for a while. Shopping centers, grocery anchored shopping centers, that's more of a mixed bag over the past few years. Some were rebounding strong lastly. It just depended on what type of center they were. Were they a local grocery anchored center? Were they a power center? What kind of tenants did they have? And were those tenants susceptible to being replaced by e-commerce? And I think you mentioned the data center and the towers as well. And I think they've benefited from some, long-term secular demand, even prior to this pandemic. People are using more and more data. People are using social media or entertainment such as Netflix or YouTube. So there's been some pretty healthy demand for data centers. It kind of comes in spurts. But long term, there's a need for more data centers. And I think you mentioned that the cell towers too, which we should note that it's not the cell phone users that pay the rent, but rather the big mobile carriers that pay the rent. And if those mobile carriers don't pay the rent, our cell phone service doesn't work. But obviously, there's been demand for that, right? Initially, there was a move from 3G to 4G. We're getting ready to move from 4G to 5G. That requires modification to leases and new equipment. So I think that the towers have really benefited from new technologies, even prior to the pandemic as well.
Right. So is it zero sum, Geoff? So let's talk about just retail versus sort of the virtual economy, right? Data centers and cell towers. Is it zero sum? All right. So we've had in retail all the disruption we've seen, and this is, by the way, pre-COVID, really only took retail sales from 15%, from 100% brick and mortar to now it's still 85% brick and mortar. So the Amazons of the world and all the disruptors of that space, they only hold 15%. I look at my kids who are 14 and 12, they're going to be only consuming virtual. They are only consuming virtual now. Their idea of a great night out is to be on FaceTime with their friends and Xbox at the same time. Like that's top of the food chain stuff for them. So what does it mean as you move out into time? And the reason I ask this is we'll get into REIT stock pricing, but you also have to be mindful of, the stock price we know. What we don't know is future growth. And that's what you spend all of your time trying to figure out, because one variable is known, one isn't. And how do you feel about these growth rates out into time? Aren't we sort of still in the early innings of this?
Yeah, it kind of seems like we are. And I think this pandemic might have accelerated some of the virtualization that we've been seeing. Is it completely zero sum? I don't know, but it's got to be pretty close. For instance, on a Friday night, you can either go to a mall, get dinner there, and go see a movie there, or you stay home, eat dinner at home, and watch a movie on Netflix. You don't do both in one night. You're not going to eat two dinners. Maybe you can squeeze in two movies if you stay home because you're not having to drive and find a parking spot. But some of these newer technologies or new methods of commerce or trade are going to replace some of the existing methods in place. And that might mean that things such as retail stores are less used than they were in the past. I think employers are taking note of telecommuting and working from home and saying, hey, maybe this worked better than we thought it would. Maybe we'll make this a permanent arrangement for some of our employees. And that means that we don't need to take expansion space in an office building anymore. Or maybe when our lease expires, we can lease less space. So I think you're seeing an acceleration of some trends that were going on. Some of them have now been forced out of necessity. So, 20 years ago, we mentioned the dot-com bubble, but, there were some companies, some startup ideas that went out of business pretty quick and some were mocked, some of those being grocery delivery. And now 20 years later, no one's laughing. Everyone wants groceries delivered to their door. It's quickly becoming a necessity.
Yeah, I can't get a delivery. We try nonstop. So we're talking about growth rates, but let's move back to stock prices. So we're focused here on retail, and we're focused on sort of the data economy, right? So take us through what those sectors have done, not the companies, but the entire retail publicly traded REIT in the downturn. So over the last month, where has that gone versus data centers and cell towers in stock price?
Right. And so initially there was a sell-off in REITs that started, late of February. Seems like things bottomed out almost a month later, kind of that third week of March. And some of those sectors that we were talking about, malls, lodging, they were hit the hardest. I'm going to include mortgage REITs in there too. They were definitely hit the hardest. But in that time, you actually had some data center names that posted positive returns. Whereas some of these other sectors were down 40, 50, 60% for the mortgage REITs. Towers were down maybe 10%, data centers, plus or minus 5%, basically hugging the line. So we really saw, who was going to benefit during this pandemic and, who just got the rug pulled out from underneath them.
Yeah. And the big point here is what happened in this massive reaction that's warranted, by the way, from the economic side of the pandemic, was a continuation of what was happening already. Retail was underperforming for the last 1 year, 3 year, 5 years, and then this just put it on hyperdrive. Hotel probably was hit even harder, right? Because obviously hotels are empty right now, and we're hoping they're not very soon, but the reality is they are. They each have their own reason. Mortgage REITs, and we'll get into that, they were hit because of just their business model, which relies on massive amounts of leverage. And so anytime there's a stress, it magnifies it. But we'll get to that. What we're trying to talk about right now is if I asked you, Geoff, hey, what happened with the publicly traded REIT market in the last 3 weeks? That's an impossible question to answer unless you break it down into sectors. And that's what I'm driving at. And so let's do it. And obviously it's changing so quickly. If we had had this call 7 business days ago, I would have told you, because Origin on the private side, we focus almost exclusively on apartments. And we own thousands and thousands of apartments across the US. And so I'm watching the public side, A, because it's part of our business at Origin, and we create and monitor these portfolios anyway. But I'm also watching it as a proxy for the privates. And so if I had looked at them 7 days ago, they were down anywhere from 35 to 30%. And this morning they're down, well, as time of this call, I'm going to say 16 to 18%. Right? Massive move. The reason I say I think is because they might be down 3 because I've been sitting here for 5 minutes. I don't know. But they're moving a lot, right? The one thing that's consistent is if you used more leverage, and Geoff, I think you should hit on this, obviously, and I should disclose this, we can never talk about individual names. We're an investment advisor. We're prohibited from doing that. We can talk about sectors and we can talk about financial structures and where we think the best expected values are, but not companies. But in a generic sense, can you take us through an example on the mortgage REIT side and maybe the apartment REIT side, both that were using more leverage and why they would be hit more, and because they were?
Right. Well, I'm going to start with the apartment REITs, and they were probably, kind of middle of the pack for REITs. Obviously, we mentioned that the data centers and the cell towers held up the best, the lodging, the malls, the mortgage REITs did the worst. But, with apartments, the concern is really like, who's going to pay their rent this month? And I know you guys talked about some preliminary data yesterday that maybe as much as 30% of renters haven't paid their rent by April 7th. That's a big issue. I've actually seen some surveys come out and say that it's even worse for the retail tenants, that potentially only 50% of retail tenants paid their rent for the month of April. So obviously that's a problem for the malls if the tenants aren't paying their rent. And they have tenants that have signed contracts. Hotels are a different story. They just have no one in them. I mean, they rent their rooms out night by night. They have no income right now. Now you mentioned the mortgage REITs. The mortgage REITs, right, they were clearly hit the hardest, and that was a use of leverage. So for anybody that doesn't know, what a mortgage REIT basically does is they buy bonds. You have your IPO, you've got some cash, you go out, you buy bonds. Now you borrow against those bonds, right? You use those bonds as collateral, borrow more cash, buy more bonds. You lend against those assets, and you've got this buildup where you're buying bonds that maybe pay 3 to 4%. Your borrowing rate is 2 to 3%, so somewhere between 1 or 2% interest spread. But when you magnify that with leverage, 8, 9, 10 to 1 leverage, you can turn a 1%, 2% net interest spread into something that's generating 9 or 10% dividends. Now, when the market for some of these bonds quickly evaporated and prices became unknown, the bonds that were used for collateral, the counterparties were making margin calls saying, hey, you need to put up more cash, put up more collateral, or we will start to liquidate these positions. And that caused a major issue for the mortgage REITs through that disruption. Deleveraging is hard. I think everyone remembers that from the great financial recession. And these mortgage REITs were forced into deleveraging very quickly in case of selling assets at giant discounts to what they were worth just a week or a few weeks earlier.
Yeah. And Geoff, it's a vicious feedback loop, right? Because the price of the assets are going down, so they're forced into margin calls, so they have to sell. And when they sell, they force the assets down more and repeat, and something has to stop the loop. Same as in 08 to 10. Origin was around then. We've experienced this type of market price action before. The Federal Reserve intervened amazingly fast this time, and it wasn't just taking interest rates to zero. That doesn't stop it. It came out and said, we're gonna start buying risk assets. And that means what Geoff is talking about, this collateral. They essentially said, look, we're going to stop this. And they did. They did stop it, or it could have gotten really, really bad. And the speed at which it got bad this time was really amazing. It's almost like everything that happened in 08 and 9 and 10 was consolidated into 1 week, and that was the week of March 9th. So from March 9th to 15th, 2 years of price action happened in 5 trading days, and some really, really crazy things happen at that point. And there's some mortgage REITs that don't exist right now. They're no longer in business because the margin call exceeded their ability to cover. The analogy I would make for people at home who are like, this seems kind of weird, think about a brokerage account that you have, and you don't buy stocks because that's not fair. They're riskier than bonds generally. You're buying fairly safe bonds, but instead of just owning that bond account, you borrow 10x to buy more bonds, right? So say you had $1 million, so you buy $1 million of bonds, and they yield 2.5%. Pretty, not that risky, but now you buy another 10 million of bonds because you borrow. You can borrow, first of all. You can't do that in a brokerage account, but for some reason, mortgage REITs can, and you do that. Well, obviously, very small movements in the underlying collateral is going to create huge waves for your account, and that's what happened in the mortgage REIT market. This is a bit of a tangent, but in my opinion, we shouldn't have business plans like that out there anymore in the economy. I don't think they should even exist. We do need to bail them out. Letting them fail is worse. It really hurts our financial system in a meaningful way. But moreover, why do they exist in the first place? That would be a better question. All right, let's move on. We've covered sector trends. I wanted to start talking about structures because, Geoff, a lot of the people on the call might not know the difference between a preferred stock and a common stock. I mean, obviously, when we're watching CNBC, those are common stocks. Those are the stocks you see every day. But there's a world out there called preferred stocks. It's actually a world that you are very much an expert in, and we believe is probably a world people should know about.
Yeah, so I mean, preferred stocks are really kind of tweeners. They kind of sit between a company's debt and their common equity. And I got a little stack of Lego bricks here, and if you can see these, the white ones here, this is the company's debt. The blue ones up here are the equity. This little green band in the middle, that's kind of where the preferred sit. And the preferred, they're very fixed income like. They typically come with a fixed coupon. I mean, could be anywhere between 5 and 8%. That rate really, it doesn't change. I mean, there's a handful of REITs that do offer fixed to floating sometime in the future, the payments based on some sort of spread over an income benchmark. But for the most part, they're fixed coupons. They have no maturity, and they usually can't be called by the company for at least 5 years. And then when they are called, you just have to look at what the company's financial position is at the time, where the current market rates are, and whether they want to replace it or just leave it outstanding. But there's some really neat features that come with the preferred. For instance, in the case of liquidation, right? Obviously, your bondholders, your debt holders are going to have the highest claim, but then it goes to the preferreds. The preferreds get preference on liquidation over any of the common. They also get preference on dividends. So in any given quarter, if a REIT is going to pay a dividend, and it has preferreds outstanding, it has to make the preferred dividend payment before they can pay anything on the common dividend. And and as we mentioned earlier, one of the rules that a REIT needs to abide by is paying out at least 90% of their taxable income as dividends. I mean, dividends are a big part of owning a REIT. So the preferred always get first claim to dividends. And most REIT preferred stocks have this label called cumulative, meaning that if a REIT is in a pinch, maybe it's a scenario similar to right now, and they skip dividend payments on the common and the preferred, those preferred payments accrue, and the REIT has to make those up in whole before they can pay anything on the common dividend.
Is the opportunity cost of a preferred stock, because I love the idea that it has protection and liquidation, it also has preferred payment. You have to pay the pref dividend before you get to the common dividend. The opportunity cost then would be your cap at your total return. Is that accurate, Geoff?
There is a potential cap on total return, right? So these things are traditionally issued at a $25 par. they typically move around with interest rates or I'll call it credit spreads, but really that's the ability of the issuer to make good on the dividend payments. Now, when we get into a scenario like a few weeks ago, when these things were being sold at fire sale prices, in some cases, the mortgage REIT preferreds are falling 70, 80%. There is a potential to make up some of that lost capital. It's not infinite like in a common stock, but if you're buying at a discount and a big discount, and there is a recovery, especially a credit recovery, you can have gains on principal in addition to the payment. But you're right, at the end of the day, the potential upside is limited on a preferred, where it is infinite on a common equity.
Yeah, that's a good point. And by the way, we can do, if people want, we can do a much deeper dive on preferred math because it's bond math. I mean, essentially, Geoff was talking about it. Most of them are issued at $25. And if you buy a fixed yield of 6%, that's the coupon, right? If you pay 25 and you're basically buying the coupon, if it's 6, you're getting 6. But if you buy it at $15, you get the coupon plus it appreciates in value to the point where it has to be repaid or the market brings it back to a higher price. And we call that yield to maturity. If there's interest, and you don't just need to send us your questions, also send us feedback. If you want a deeper dive on a specific topic, we're trying to go broad today, but we can also go deep. Geoff, given that, we are where we are in the market, and by the way, we're a heck of a lot higher than we were. One of the questions we had from an investor, which no longer is true, especially sector specific, is why have REIT stocks gone down more than the S&P? That's a nuanced answer. It's not true for certain sectors. It is true for others. We've sort of touched on that. But it's also just broadly not as true, period. And it's really because real estate has borne the brunt of the credit crisis. Because if people can't pay rent, that's how real estate then pays their own mortgages. How do we pay our debt if we can't collect rent? And so April collections, and Geoff touched on this as well, I've also read the anecdotal, but we have our own data because we have thousands of units. April collections have been far better than what we expected. I'll just say that. Will that continue? I don't know. I would guess it's going to be harder in May, not easier. But April has been pretty good. So it doesn't, and I think the market as a whole is sort of realizing that, and that's why REITs have done so well along with the market. So let's move on. I want to ask you a question. It's really structural again. Where do you see the best opportunities in the public markets right now?
Right, and we talk about this a lot, and this changes, week to week. It's kind of hard to imagine, but REITs are up almost 40% off of their March bottom. It's like 38, 39% in like 2 weeks. So with the liquidity that you get with the REIT market means that things can move around. So a few weeks ago, I said, hey, these data center preferreds are great. You can buy them at a discount. These have great long-term fundamentals. The credit is good. But if you were to look at some data center REIT preferreds now, you might find, well, the yield on the price today is, 5, 6, 7%. And they're maybe within 5 or 10% of their February high. So you put your coupon and your potential capital appreciation together, and you're maybe talking about a 10% return. That's fine. Yeah. But I think longer term, with the demand for the type of services that the data centers and the cell towers provide, you're probably better off paying the equity and investing for that long-term growth where you have the unlimited upside. These companies could easily increase the stock price, 8 to 10% a given year. And with the preferred example, you only get the price appreciation once, and then you're kind of stuck with the coupon at the time. If you are looking for some opportunities, We are starting to see some recovery in whether it's retail or the hotel section or even the mortgage REITs. And I think if you're going to go after one of those sectors that's had a little bit more issue, the preferred space might be a better place to look. One, we talked about protection in the capital stack that the preferred has, priority on dividends, preference in a liquidation. But you're also looking at stocks that, there may be, it depends on what company or what sector, but the yields on these preferreds are anywhere between 10 and 50%. And some of them are still, 30, 40, 50, 60% below their February highs. So you've got a much bigger potential for price appreciation, a much bigger coupon that comes along with it. I would just note that you should be careful and make sure that if you are investing in whether it's a hotel preferred or a mall preferred, that you do feel good about the enterprise, that they're going to survive this crisis. The mortgage REITs, I'll use my Lego block example again. When things start to go south, it's the equity that disappears and your capital stack looks much different. You no longer have all that equity cushion. And once that equity is all the way gone, then you start to dip into the preferred. So you do want to make sure that if you're investing in riskier securities, that the company is going to be a survivor.
And Geoff, lastly, because I know you spend a lot of your time on this, we spent a lot of time on sector. Now we've spent some time on structure. But the other thing that you're spending a tremendous amount of time on is looking at management teams. And so how important is that to you when you're evaluating a company? And how do times like these really reflect the management team's skill and acumen?
Right. Well, I think the first thing is, when the tide goes out, you see which company's CFO had a conservative positioning in leverage, right? So, put the mortgage REITs aside, they use a lot of leverage. But when you look at the equity REITs, that's the REITs that own physical buildings, there's a wide variety and amount of leverage that they can use. And it varies from none to a lot. And those that were using higher leverage or had a disproportionate amount of preferred stock in their capital structure and not a lot of equity buffer, that is appearing in their share prices now. You also find out what management teams were able to, whether it's stop development, stop new deals, who was able to position themselves not just to be protected during this downturn, and some of this will play out over the next 12 to 18 months, but who's going to be in a position to play offense? Were any of them, trying to strike deals and buy assets on the dirt cheap recently? So yeah, it is really telling on what management teams can create value versus, there's some that they destroyed value along the way, and they're not worth the pay that they get.
Yeah. We're going to move on. We actually have a lot of time. We have about 25 minutes, and I want to move on to Origin Take 5, where I'm going to ask Geoff questions. He's going to answer them in 5 to 15 seconds. So I think this should be fun. It was yesterday. I also see there's been a lot of questions today in the Q&A function. So we should have plenty of questions, and we should probably get through all of them. So let's get started. First question, Geoff. What are some characteristics of REITs we should be looking to invest in this type of market environment?
Right. So, I think right now the most important is balance sheet. Any REIT you look at, you first need to make sure that they're going to weather the storm, that they're going to get through this, not have to do dilutive transactions, such as we mentioned with the mortgage REITs. That's, selling assets at fire sale prices. We want to look for growth. It's kind of difficult because we just don't know how some of these sectors are going to play out. But I think it also goes back to, if you can identify who's paying the REIT's rent, you'll have a better grasp of how soon they can recover and get back into a more normal mode. We talked about the apartment collections. I know I mentioned the retail collections earlier. I mean, you've had two major retail tenants, the Cheesecake Factory and AMC Theaters, basically tell their landlords, we're not paying rent for April. We don't know when we're going to pay, rent again. So pay attention to who's paying the rent. It's more than 5, isn't it?
Geoff, that's like 45 seconds. So we're going to try this again.
We need a buzzer.
This is really hard for Geoff because he knows every single ticker and can talk about them for an hour. So you're going to have to do what you just did in 1/3 the time.
Seconds.
Are you ready?
Do it
All
again
right,
next.
let's do it again. This is live TV. All right, here we go. You mentioned mortgage REITs briefly. I read that those are down very much right now. How can you explain what happened?
Yeah, I think we did that earlier. They were leveraged,
Yep.
had to sell assets to deleverage. They had margin calls, and it's painful to delever.
I love it. That's great. What are your thoughts on what an investor should do if they are heavily allocated to some of the REIT asset classes that you mentioned weren't even doing before the crisis? Should we hold steady or should we get out?
Depends where you are in the capital structure. And like I said, the first thing you better do is look at that REIT's balance sheet and make sure they're a survivor. If they're a survivor, you've got a decision, hold or sell. If you don't think they're going to be a survivor, you probably should get rid of it.
How are investors taxed on REITs? Not the corporate level, the investor themselves.
I get a tax question with 5 seconds. For the most part,
that's tough.
For the most part, they're taxed the same as stocks when you buy or sell. Capital gains could be short-term, could be long-term. Dividends are taxed as well. The taxation of dividends is a little bit different than some of the other stocks in the S&P 500, but REITs do qualify for a 20% dividend pass-through per the Tax Cut and Jobs Act. But the characteristics of dividends could be ordinary income, qualified dividend, the REIT pass-through I mentioned, short-term, long-term, return of capital.
All right. So that was an unfair question. That's really hard. But I will say what's really cool is with REIT dividends, and Geoff's touching on this, you get an additional 20% tax reduction because they're REIT structures. And that was part of President Trump's tax reform bill of 2018. And so that's not because you're at origin. It just means that all REITs get those. And what it really did was it made a great product already from a tax efficiency standpoint even better. So obviously we like that. And on our private side, our taxable funds, private funds, are also structured with subsidiary REITs so that dividends on those products also get this tax benefit. All right. Does Origin invest in international REITs? No. That was pretty good. I got our average back down, Geoff. Do REITs charge fees, Geoff?
No, well, we're talking about the exchange-listed public REITs. They do not charge fees directly to shareholders. Non-traded public REITs, right? These are REITs that are sold by a sponsor. They may charge fees. Only fees you would pay is whether it's a mutual fund fee, an ETF fee, an investment advisory fee. REITs do have general administrative loans. They have employees. They pay their employees, but there's no fees directly passed to you from a REIT.
How many REITs are there, publicly traded REITs?
In the U.S., 220, about 40 of those are mortgage REITs, so plus or minus 180. Internationally, maybe it's, I used to know this, it's like 400 or 500.
And how much debt do REITs typically use? I know that varies by sector, but maybe just apartments and office, just to name two.
Well, as I mentioned, it could be 0 up to a mortgage REIT of 90%. Typically it's just under 50%. Again, it depends on the REIT. Are they doing development or are they just holding stable assets? Are these trophy office buildings or are these more flex suburban office assets, but it varies. Usually a little less than 50%.
So these are other questions we had before today, and then I'll segue into today's questions. But I'll answer this one quickly. It was a question about, I've seen REITs are down 20 to 35%, but there's also private market assets that are still closing and trading either at their price or down 2 or down 5%. How can that be? And the answer, because we obviously do both and we see both public and private. The private market takes anywhere from 60 to 180 days to reprice. And the reason is transactions take that long. If you start a transaction, it usually takes 60 days of due diligence, 30 more days to close. So all of the private market transactions that are closing, they're not many closing anymore, but The few that are represent pricing from February, March. Some of those are trading at discounts, some aren't, but they're all lagging indicators. And so generally, Geoff, you can call me on this, I'm over 15 seconds, but the opportunities and corrections are in the public markets. You know, what happened, what Geoff saw, things trading down 40%, down 50%, down 30%, et cetera, none of that will show up in the private markets for another quarter. The flip side is the private market is the place to be as a lagging indicator in a recovery. So if you look back at the period 08-10, the public market had all the opportunities, the best opportunities, I should say, in that period. And then probably the best opportunities from 2010 to 2012 were actually in the private market because they were lagging and they were reflecting pricing from 09 and 10, even though it was much later. I'm going to keep going. Do syndications have any kind of mark-to-market on debt? Can you be forced to raise capital due to a valuation haircut on an asset?
Well, the mortgage rates,
I can handle that. Yeah. And on the private side too. So another question we had is actually from yesterday was, why would a private market owner ever sell an asset if it was, you know, pricing lower? And the answer is a lot of the times your debt forces you to, right? So if you have a debt maturity or debt covenant violation with a lender, they might require you to inject more equity into the project to keep it or the building. And if you don't have it, you don't have it. You have to sell. It's sort of like a margin call on a private asset. Why are public REITs going down much harder than the rest of the market? That actually isn't true anymore and is a segmented question. I think we covered it. Isn't it too early for opportunities? In Spain, all the smart sellers have put their properties off the market. Shouldn't we expect the real estate market to not correct until 6 to 9 months? Geoff, you want to answer that?
Only hindsight will tell, but the best opportunities might have been in that third week of March. Like I said, REITs are already 40% off the bottom. I know they're still down year to date. They're still down maybe 14% year to date. Doing the math, that means that they would need to fall, I don't know, somewhere between 25 and 30% if they want to probe those March lows again. It seems that we're making progress against this virus. I think maybe the best opportunities are gone, but there's still some opportunities going forward.
Yeah, and I'll just tell you my opinion, and if you heard it yesterday, it'll be a little bit redundant, but if the stock market's down 14% and REITs are down similarly, that's almost like a correction. I mean, you could argue that's a correction. I don't believe that this pandemic is a correction. I think it's much, much more serious than that. And I think that longer term growth will be affected and it'll be lower. And so I would, I don't want to tell you how to think. You're going to make your own conclusions, but I would be wary of investing money at these valuations unless you really believe, A, I'm wrong, and that growth is going to be much quicker coming out of the lockdown. And it's also capital that has a long-term outlook, and you're not going to change your mind if we do go back and retest the lows and you feel differently about. So those are sort of the two questions to answer as an investor right now is, where's growth going? That's your opinion. I shared mine. And secondly, what's my outlook and how long am I willing to be? Now, on the bullish side, real estate and publicly traded REITs are no different. Over a 10-year horizon, always makes money. And obviously, there's a million different ways you can say, but it needs this, but it needs that. I mean, I'm talking about very broadly with good assets and good management. People can make mistakes selecting the wrong teams, et cetera, but generally, it's a very safe asset that makes you money over time. And by the way, that's why we entered the asset. That's why we founded Origin 13 years ago, was to protect and grow capital. And real estate was where we thought would be the best place to do that. Speaking of stimulus, domestically within the U.S. and its effects on markets, is there a risk that there's too many dollars printed, too much money put into the system? What could possibly happen with sort of an overstimulus, too much fiscal, too much Fed, too much money?
Boy, that's a big loaded economics question. I mean, in the short
15
term,
seconds.
we got a lot of slack to work through right now. We got to work through the slack. Once we get beyond the slack, right, then you can say, all right, how can the government peel back some of this stimulus? Because it's not an easy thing to do. But I think inflation due to the stimulus, that's got to be a year or multiple years away.
Right. Yeah, and I would just add that there is a risk of printing tremendous amounts of money and borrowing money and over stimulus. There's a risk of that. It's real. There's also a risk of there not being enough demand, and it would be deflationary, and that's a risk too. So I would just caution about be careful for what you're afraid of. That's an inflationary question. Like, if you're going to have so much money printing and stimulus, could it be inflationary? The answer is it could be, and it also could be that it's not enough and it's deflationary. And if I had to pick one of the two, I'd pick inflation. I think deflation is much more scary. Okay, I've moved to live questions. The first question we will answer not live because it's a question about individual stocks and we can't answer. But the person who asked it, it's a very good question, and I wish I could answer it, but I can't. Next question. What's the advantage of a REIT versus a typical pass-through entity such as an LLC?
Well, I mean, I guess you're talking about holding part of an LLC directly. I mean, with a REIT, it trades on a national exchange. You get daily liquidity. You can sell it or buy it anytime the markets are open. You can get a price right away. You get a 1099 at the end of the year. It's very easy to do your taxes with. If you're a direct owner of an LLC, you're going to get some other sort of statements, and you're not going to have that sort of liquidity.
Yeah. And the other advantage, I touched on this before, because our private funds were structured as LLCs, and even at the asset level, individual SPEs that held each asset. So they're not cross-collateralized. But I think the question is, an LLC is a flow-through. Why is that different than a REIT? And the answer is the REIT designation, which requires 90% distribution. LLCs don't. But it comes now with this additional benefit as being a REIT of 20% less taxes on dividends. An LLC doesn't have that designation. And what we did to make sure our private funds had that is we created subsidiary REITs so that we would get that. So there actually is a significant economic difference too. The next question, but it's in response to our conversation. Is there no tax benefit if you own a REIT stock? And I think, Geoff, that's, well, you can go ahead and answer that, but I think there's some confusion there, but the answer is no. Go ahead.
Well, is there no tax benefit? I mean, you don't get the pass-through of depreciation and expenses.
True.
You know, when you sell it, you could harvest a taxable loss, or it could be a gain. I mean, it could go either way. Obviously, taxable losses, realized losses, you could use to offset ordinary income. So I think there are some benefits. They're just not that different than common stocks.
Yep. The next question. This is someone who joined probably a little late. What do you think of investing in Mexican, Brazilian, and English REITs? We don't cover international REITs, so we can't speak to those. Those are great questions, but we can't answer that. Wow, this is updating so fast, it's scrolling on me. What criteria do you use in picking REITs, Geoff? Great question.
Right. Well, I mean, obviously, different scenarios require a different process. Right now, I said, like, number one is about the balance sheet. But in a more normal environment, you want to look at earnings growth, how much you're paying per unit of earnings growth. Typically, I would prefer less leverage to more leverage. So in management teams that can create value along the way. So balance sheet, growth, cash flow stability, diversification among their tenants. And you want to look at the physicality of assets too. Are these well-maintained, enduring assets, or is this just junk? Great
answer. Next question. Well, let me ask you a question, because I touched on this before, but if you believe, because I'm actually responding to a question that was asked, it's a good one. At what point is the pricing premium on data centers and cell towers too great? And, you know, they're asking about the relationship between price, which we know, and future growth, which we don't. It's a strong secular trend, right, to the virtual economy, and it's worked. It's worked over the last 3 years. It worked in the downturn too, so far. What's your opinion on the sector? And that incorporates price and growth.
Yeah, and I think a lot of it depends on that growth and on whether that growth is likely to be more or less than the current expectation. And I think what we've seen, at least to date, is that the demand for data centers has been more than what we've expected. And we've talked a little bit about this virtualization accelerating due to this pandemic, people working from home, being forced to use more data. I can see that trend's continuing. People may realize that, you know, I don't need to fly to New York for a meeting. We'll just fire up Zoom, save everybody a lot of money and time. I know you gave an example about, you know, travel expenses yesterday, and I think a lot of that applies. And we may not see the demand for retail, malls, or lodging, or even office ever kind of return back to the levels that we had before, right? So there, if you look at the long-term trend, the growth is going to be disappointing compared to what it was previously. Whereas data centers and potentially cell towers, that growth could be more than what we expected. And those are the kind of scenarios where a premium to net asset value or a higher multiple is warranted versus some of the deep discounts we're seeing in some of the more distressed sectors.
So I'm actually going to answer a question because it's coming in from one of my favorite longtime investors. I won't name him, but you know who you are by the question. Is Origin better off buying the underlying distressed assets in the private market or buying REITs and preferred stocks on REITs in the public sector? It's a great question, and I'm not equivocating with the answer. We will and should be buying both. Every portfolio should have both, and we do have both. But I think that today the better opportunities are generally in the public sector because it reacts much, much faster than the private sector. And so what I don't have any interest in at all are deals on the private side that are 5 or 10% lower in price than they were a month ago. That said, a lot of the times these worlds converge. For example, a lot of the distress in the public sector actually creates opportunities for us to either purchase or partner with publicly traded companies on portfolio assets. And so these would be private transactions that are actually related to the public sector distress. And so a lot of this is sort of in the soup, but broadly, to answer the question, public first, then private. I think there's going to be some really interesting private opportunities, and we're chasing them. All right. What thoughts, Geoff, do you think about REITs on that use collateral from affordable multifamily housing or own them?
Yeah, there hasn't been, unfortunately, for the most part, REITs own the best assets, the Class A or maybe kind of the B plus. There's not a large affordable component in many of the apartment REIT portfolios. Yet there was an example, they largely exited that business. So, I mean, the REITs have kind of been running away from that. So we just don't see a lot of that in the REIT investable universe.
Another sector question. What are your thoughts, and obviously this is, again, price and growth prospects, price is known, growth isn't, on medical office, hospital, and to some extent mixed strategy medical use REITs?
Yeah, well, I mean, the hospitals, obviously some of them are having issues today. Occupancy is not one of them. The healthcare systems may be stressed in other regards, but typically you've got decent tenants in place. Medical office is a little bit more mixed, and this is just anecdotal. I had a doctor's appointment a few weeks ago. We did it on a video conference just like that. Obviously, you can't fix a broken bone that way, or do a swab for a strep test. But some more routine visits I think could become virtual. Senior housing, right? Obviously, the senior housing owners have been devastated recently. There's been some rebound, but this coronavirus has disproportionately affected the more elderly population. It's also limited new residents wanting to move in those facilities. Granted, we do have a lot of baby boomers getting ready to retire, so there is a need for senior living. One definite bright spot in the healthcare sector, I think, is lab space. And you may find this within the healthcare REITs, you may find it within some of the office REITs, but when this pandemic has settled, I almost guarantee you this country is going to spend more money researching viruses, looking for cures, and trying to make other medical breakthroughs that we wish we would have had. So I think you're going to see increased funding, whether it's venture capital, whether it's NHI grants. You're going to see increased demand for lab space.
Yeah, and Geoff, that's exactly what you're paid to do, is to see the trend before the trend, and that in REIT investment, no, it's not unlike any other investment. That's how you do well, as you get ahead of the trend. That's a very astute observation. I see a question here from it's an owner and sophisticated operator of multifamily, and the question, it's quite long, but it's basically asking, where do you think cap rates are today versus a month ago in multifamily? And thanks for the question. It's segmented quite a bit, but generally, I believe that if you hold net operating income, NOI, fixed, and that's a huge assumption, right? Because NOI is probably lower, but I'm going to hold it fixed so we can only focus on the cap rate component. I think that generally Class A was trading plus or minus 4% cap rates. We had, for example, a Texas asset that we were selling to a publicly traded REIT at a 3.8 cap that has probably fallen out. It's still under contract, but I surely doubt it will trade. So that corroborates the 4. Then I think now it's more like Class A is, I'll give a range, 4.8 to 5.5. That's what I think. There's no private data to suggest that. I'm basing it on publicly traded proxies. We've talked about that. That's what this call is about, as well as what I see people walking away from in terms of hard deposits on private transactions. And so I won't name the firm, but there's some very well-known smart firms that are walking away from 3 to 5% deposits, sometimes even higher, 6 or 7. And so if they're willing to do that, obviously they think the market is lower than that. And if you back that through the equation, it'll get you to, a 5 cap pretty quickly. The last question, because I'm determined to keep us on time and we're doing great, is really a question about our public side. It's a great question. So the question is, how do investors, accredited investors, or just investors in general, how do they participate in Origin's publicly, our public portfolio of REIT products? So Geoff, maybe let's talk about 1 or 2 of these portfolios, maybe the income portfolio and the growth portfolio. Like, how would they participate? How can they get involved?
Yeah, I think the first thing is to download the Path by Origin app. That's available in the Apple and the Google application stores. And what we did, Dave mentioned 2 blocks. One is an income block. It's a basket of strictly REIT preferred stocks, so 100% preferred stocks in our income block. These are some of the preferred securities that I like right now. And then he mentioned the growth block. That would be our all equity REITs. So there's no mortgage REITs in the growth block. These are equity REITs that we have a favorable opinion of. And again, it's a basket of all equity REITs. So it's a little bit of all the different sectors. And you could use this in lieu of an ETF or a mutual fund to gain public real estate exposure.
Yeah. So thank you. Just download Path. I think you'll see that we're completely transparent. All of the stocks that Geoff is selecting for each REIT basket, we not only tell you about the stock, but we tell you the weighting of each portfolio. We're very transparent with that. Thank you for your time. And Geoff, I don't think people realize that we could have done an hour on one stock with you. So I know this was hard. I thought you did really well, actually, at trying to shy away from the. There's an entire jargon that REIT experts, portfolio managers, and analysts use, and we did not use it. Acronyms and words, and we tried to convey that without going there. If there's interest in going deeper, we can. Thank you for your time, the listeners. I hope you found this useful. There are a bunch of questions we didn't get to, and so we're going to try to answer those individually or have subsequent shows on that. Be safe, and let's all make it through and get to the other side. For now, goodbye.